Damned if they do, damned if they don't. After being slammed at the Banking Royal Commission for lending customers more than they could afford, banks have tightened up on home loans. Now the government's urging the banks to free up credit amid fears for the economy.
We're seeing a slowdown across the board.
Mortgage broker Fiona McManus has been helping people get home loans for 8 years, and she's never known the like of it.
I have not seen it as tough as this. We're seeing the banks are coming down heavily on credit. They're looking at bank statements line by line to make sure people are not over-borrowing.
After years of lax lending, the Treasurer seems to think the banks are now being too cautious.
My message is still very clear to the banks. Keep your books open. You have a social and economic responsibility to do so, and it's in the economy's interests and it's in the public's interests.
Come through here. Thank you. It's a very big house.
Last year, house prices suffered their biggest loss since the global financial crisis, and there's worse to come.
If you restrict funds, it's like water. It's like anything. You need circulation of funds for everyone to be moving around and buying and selling more easily.
Official figures show housing credit growth has slowed to an annual pace of 4.9%, well below the 10-year average rate of 6.3%.
So the downside risks to the economy are building by the day, and with every month where we see house prices fall.
The government's using that risk to attack Labor's policy to limit negative gearing tax concessions to newly built dwellings.
It was a policy that was prepared at a different time when prices were going up. Now that prices are coming down, it's time that the Labor Party abandoned this terrible policy.
We want first home buyers to be able to get a foot in the door to get their first place.
Small business owners, who often use their homes as collateral for business loans, are also feeling the squeeze.
With the tightening in credit that we're seeing linked to the fall in house prices, the small business sector is under a lot of pressure.
For a long time, the expectation was that the next move in the Reserve Bank's official interest rate would be up. Now markets are pricing in a rates cut by year's end, and many economists are tipping more than one, which might suggest the credit crackdown has been too successful.
I don't think it's a bad thing because I think in the past people have borrowed, more than what they can afford.
But an economy addicted to easy credit can't be weaned without pain. Stephen Long, ABC News.
Martin North is a housing analyst with Digital Finance Analytics, and he joins me now. Martin North, the Banking Royal Commission is behind us, along with a series of banking inquiries, all of which criticise the banks for irresponsible lending. The banks then tighten lending. Now, today, Josh Frydenberg has effectively asked the banks to loosen up a bit. What is the Treasurer's motivation, do you think?
Well, if you go back a little bit, it was effectively household consumption that drove the economy forward after the mining boom. And that's something that the RBA, the Treasury, and even the regulators were all keen to do. But it went on for too long. And so we've got this overhang of debt. The banks were lending very, very freely and, frankly, were breaking some of their own lending rules as well. And so we've got, a lot of people who are really up to the gills in terms of debt at the moment. So the tricky situation we have now is that because debt drives home prices and also drives the economy, as we take the lending away, as it were, momentum slows. But the problem is that the banks are still lending, and there's, growth is still higher than wages growth, and they're now complying with the rules that were put in place a decade ago. So essentially what people are saying, if they want to start the banks off again, is to say it's okay to break the law, and I don't think that's right.
If that's the case, is it responsible for a Treasurer to ask the banks to, in his words, keep your books open, when the banks are, as you say, doing what they think is the most responsible thing after being wrapped over the knuckles at the Royal Commission?
Well, I find it a bit troublesome because, to my mind, just simply saying let's turn the debt tap on again, let's let house prices run away again, will simply create a bigger problem down the track. Debt, it has to be repaid at some point. And, we have more than 1 million households with a mortgage who are struggling to make the mortgage repayments today. We don't want to stoke that fire more. And also, even now, home prices relative to income are significantly higher than in most other countries around the world. So there isn't really much headroom, in my mind, to be able to loosen those controls. Now, there will be some borrowers that potentially should be able to get loans when they can't. But to my mind, simply saying to the banks, go back to the status quo, that's not acceptable. The new normal is tighter lending. That's appropriate. That's what the Royal Commission, I think, will come out later in the year and underscore, we have to now navigate through to this new environment.
But let's be honest, do you think the banks will actually and realistically loosen up their lending standards? Is that realistic?
Well, what's interesting is that although APRA has given them a little leeway on some fronts, in other ways they have underscored the necessity to really dive into income and expenditure. And our analysis shows that around 40% of loan applications are now being rejected, compared with 5% a year ago, because people don't actually meet the lending criteria. So essentially, either you say that the banks have now got it right and they're lending to standard and to the law, or you're saying that they actually were right previously. Well, we know that from the Royal Commission, they weren't actually doing it right previously. There was even illegal behaviour, potentially. So I think the new normal is right, but that does mean that we're going to see lower credit growth, and that does mean that home prices are probably going to fall further.
Is there an easy way out of this? I mean, can we actually unwind credit growth without the economy falling over?
It's really tricky to do. And in fact, I've studied many boom and bust cycles, particularly in the housing sector, and never around the world has there been a easy landing, a slow landing. It's always gone to the point where effectively it drops significantly, there's a correction, and then it starts again. So we are in very difficult territory here. The problem is we've had interest rates way too low for too long, thanks to the RBA. We've had too loose lending standards for too long. We've been addicted to debt, and we have to find a way out of it. But it really is a very tricky thing. But frankly, just saying let's turn the debt taps back on is a short-sighted and irresponsible thing to be doing, in my view.
Well, just briefly, the futures markets are pricing in a rate cut by the end of the year. The Reserve Bank is maintaining it's likely to be up. What's your view about how rates will go?
Well, it's tricky because essentially, you know, the dollar dived today and recovered a little bit, but essentially it's going to make it harder to keep rates low. In fact, you might argue you want to lift rates to try and attract overseas investment. On the other hand, there are calls for rates to go down. My own view is the RBA will be forced to take rates lower later in the year, simply because the economic momentum will continue to sag, GDP will continue to effectively go backwards, and home prices will continue to fall. We are, I think, looking at a few tricky months ahead.
Martin North, thanks for your insights.
Good to talk to you.